For years now, I've been building out my dividend growth portfolio that now pays me over $5,000 annually in dividends, and I recently even had a month where my dividend portfolio paid me $934.25 in dividend income. In fact, the end goal of my dividend portfolio is to one day be able to live off dividend payments. I've been sharing my portfolio every month here for the past few years, and in this video, I'm going to be explaining how if you want to maximize dividend income long term, you need to buy dividend growth stocks, and I'll also be addressing some commonly asked questions and misunderstandings about dividend investing. Looking at my dividend portfolio tracker, which you can download on my Patreon page at the link in the description, again, we can see my expected yearly dividend income sitting at over $5,000, and it comes out on average to around $420 paid to me every single month. Now, one of the big misunderstandings a lot of people have with dividend investing is that the only way you can get returns from your investments in dividend investing is through dividends. But if we jump over to my investment dashboard, I'll go ahead and zoom in quite a bit and come over here. We can see I've seen over $28,730 in gains from my dividend portfolio. Now, a large reason I've seen so much gains from my dividend portfolio is not because I invest in just dividend stocks, but because I invest into dividend growth stocks. Dividend growth stocks are companies that have the ability to increase the amount they pay out in dividends every single year. So for example, let's jump over to Seeking Alpha. We're currently looking at Texas Instruments, stock ticker TXN. If we click on dividends and look at the dividend history for Texas Instruments, over the past 10 years, we can see this company went from paying out 30 cents per share in dividends quarterly all the way now to $1.30. That is a massive increase in the amount they pay out in dividends every single year. So what are some of the key differences between just dividend stocks and dividend growth stocks? And this is really important to understand because, again, a lot of the times just dividend stocks don't see a lot of share price appreciation, and they also don't increase their dividend payouts. Which leads me to an even more important question. What is it that causes a company's share price to increase over time? And also, what is it that gives them the ability to increase their dividend payouts over time? To answer this, let's look at another example, and this time we'll be looking at Lowe's company, stock ticker LOW. This is a company that over the past decade has done very well, outperforming the S&P 500 up 360%. Now, during the same time period, if we look at the dividend history for this company, again, we'll see they did a phenomenal job of increasing the amount they pay out in dividends to their shareholders over this time period. So what gave them the ability to increase their dividend payouts? And also, what was the cause behind seeing such massive share price appreciation during this time period? And the answer lies in the one key metric that gives companies the ability to reward their shareholders, and that is free cash flow per share. If we jump over to the financials and click on cash flow statement and scroll all the way down, we should be able to find free cash flow per share, and it looks like it's right here for Lowe's. If we look at this charted out, we can see Lowe's has dramatically increased their free cash flow per share over the past decade. Now, free cash flow per share is simply your net income minus capital expenditures divided by total shares outstanding. Now, growing free cash flow is important for a company because there's 5 different things a company can do with their free cash flow. Number 1 is a company can reinvest back into their business. This is probably the most important one as it allows the company to grow rapidly over time. Number 2, they can buy back shares, another way to reward shareholders. 3, they can pay out dividends. 4, they can pay out debt. And 5, they can attempt mergers and acquisitions. All 5 of those are ways that a company can reward shareholders. So when investors see that a company's free cash flow per share is increasing dramatically over time, they know that the company's ability to reward them as a shareholder is also increasing. And as a result of this, investors start buying the stock, which pushes the stock price higher. And we can see over the past 10 years, due to rapid free cash flow growth from Lowe's, they saw massive share price appreciation. And this reminds me of a very important concept that I put out on Twitter/X just the other day. Over the short term, stock market prices are moved by the news and investor sentiment, but over the long term, stock prices are moved by free cash flow per share growth. So obviously over the past decade, we had small time periods where Lowe's stock price would jump up and then come down drastically, but over the long term, their stock price increased dramatically because of the company's growth of free cash flow per share. And again, because dividends are paid out of free cash flow, this also gave them the ability to dramatically increase the amount they pay out in dividends every single year, going from 18 cents per share all the way up to now $1.10 per share. Now let's look at a different example of a high-yielding dividend stock such as AT&T, stock ticker T. We can see this company has a large starting dividend yield sitting at 6.26%. Now let's look at what their free cash flow per share growth has looked like over the past decade. If we scroll down again on the statement of cash flows and look at their free cash flow per share charted out, we can see over the past decade it's kind of been all over the place with virtually no growth. So what's been the end result of this? If we jump over to the summary tab and look at the past 10 years, we can see the company is actually down almost 30%, way underperforming the market. But also because they didn't grow their free cash flow per share, if we look at the dividend history for this company, we really didn't see almost any dividend growth over the past decade, and in fact, we saw a pretty massive dividend cut from this company in 2022. Now, if we look at their counterpart, Verizon Communications, stock ticker VZ, you may think on the surface level it looks a little bit better. If we look at the 10-year chart, we can see a slow but steady increase in their dividend payouts over time. But if we look at the dividend growth rates for this company, we can see the 3, 5, and 10-year dividend growth rates all around 2%. But because that dividend growth rate is lower than the rate of inflation, this company is technically paying out less in dividends every single year. Now, the magic of dividend growth stocks increasing their payouts at a rapid rate is that it allows the compounding effect to take place. So let's look at Texas Instruments again. If we click over here on dividends, we already looked at the dividend history and saw a nice history, but if we click on dividend yield and scroll down, we can see over the past decade, the company's dividend yield for the most part has stayed around 2 or 3.5%, so nothing too crazy. But if we scroll down and look at their yield on cost over the past decade, look at if we invested in this company around 10 years ago, our yield on cost would be right at 11.86%. So that means a one-time $1,000 investment would now be paying us over around $118 every single year. And keep in mind that doesn't even include if we reinvested dividends during that time period. So on the surface level, it may feel like at first you're not getting paid much in dividends, but the amount you get in dividends with dividend growth stocks increases dramatically over time. Now, when I talk about my personal dividend growth portfolio, there's a lot of questions that I get every single month. And the 3 most popular are: why do dividends even matter? Why not invest in higher yielding stocks? And 3, why not use a high yield savings account that has a yield of around 4 or 5%? And these are phenomenal questions, and these are actually the exact same questions that I had when I first started dividend investing. So let's go ahead and dive into them. Now, the first question we're going to address is, why do dividends even matter? And this is actually a better question than a lot of people realize, because like I mentioned earlier, a company can use their free cash flow in 5 different ways, with paying out dividends being just one of them. Now, the most popular way to use free cash flow is to reinvest back into the business. Again, if a company wants the ability to grow, this is obviously something they need to be doing. So why would a company pay out dividends when they could reinvest it back into the business? And fortunately, we have a phenomenal example that just happened recently. Meta Platforms, the company that owns Facebook and Instagram, just recently announced that they're going to be initiating a quarterly dividend. Now, this is one of the most massive companies in the entire world, with a market cap of over $1.17 trillion. The company has seen rapid growth over the past decade and is up over 577%. Now, here's where things get crazy. If we click on financials, again go to the statement of cash flows looking for cash flow per share, scroll all the way down, we can see over the past decade the company has seen massive free cash flow per share growth. Now, this is still a fairly young company, so historically speaking, for the most part, the main focus for this company with their free cash flow has been reinvesting back into the business. And in the early stages of a company's lifespan, this no doubt makes a lot of sense, as obviously it allows them to grow at a faster rate. But here's the problem that Meta's been having recently, and honestly, it's a phenomenal problem to have. If we go over to the balance sheet, I'll scroll down, look at the total short-term and cash investments, sitting at around $65 billion. If we scroll down and look at the total current assets, it's sitting at around $85 billion. Now, if we scroll down even more, one of the things I want to point out is if we look at total long-term debt, it's sitting at just $18 billion, and total current liabilities just around $32 billion. So basically what I'm saying is this is a company with a very healthy balance sheet that is absolutely drowning in cash. The company has been able to rapidly increase their free cash flow per share, has low levels of debt, and very high levels of cash. So historically speaking, the company's main use of free cash flow was to reinvest back into the business. But at a certain point, it becomes difficult for management to reinvest this capital and get a high return on their investment. And again, Meta is a perfect example. If we look at just a couple of years ago, we can see Meta spent over $36 billion building the metaverse, but it still has very little to show for it. And again, this was an article back in October of 2022, so their spending since then is probably even higher. So really, this was Meta's attempt at reinvesting $36 billion of their free cash flow in hopes that they'll get a high level of return on their investment. Now, the problem with this investment is it was extremely unprofitable. It was basically the equivalent of burning their cash. And this was something Meta's management team eventually realized. So because they didn't know how to intelligently reinvest all of their capital back into the business, they announced a quarterly dividend. And I went ahead and broke it down. Their quarterly dividend announcement was around 50 cents, which comes out to an annual dividend of $2 per share, giving them a starting starting dividend yield of just 0.44%. Now here's where things get interesting. We can see this gives them a payout ratio of around 10% and a cash flow payout ratio of around 11.74%. That means around 11.74% of their free cash flow is being used to pay out dividends. So now when management looks at Meta's high levels of cash, looks at their healthy balance sheet and their high levels of free cash flow growth, they have to ask themselves, can they intelligently reinvest all that capital, or is it better off if they reward their shareholders in the form of dividends? A dividend helps focus management's attention on the highest return on investment projects. Any cash flow that can't be deployed at an attractive rate of return should be sent back to shareholders. And when management fails to do this, that money typically gets wasted on unprofitable projects like we saw with Meta and the metaverse. So Meta is really a perfect example of a company that should be paying out dividends. But now this doesn't mean they're going to stop reinvesting back into the business, because again, they're only using 11.74% of their cash flow to pay out dividends. That means still around 90% of their free cash flow can be used to reinvest back into the business, which in turn will give them the ability to rapidly increase their dividend payouts over time. Now Meta is not the first massive tech company to start paying out dividends. This is something Microsoft has been doing for a very long time, and again, we can see the end result has been massive dividend growth. If we look at Microsoft's 10-year dividend growth history, they've been able to increase dividend payouts going from 28 cents per share all the way up to now 75 cents per share. And what's beautiful about this is if we look at the dividend safety for Microsoft, we can see their cash flow payout ratio still only sitting at around 20%. So because they've been massively reinvesting back into their business, even though they've been increasing their dividend payouts, their cash flow payout ratio has stayed around the same because their free cash flow per share growth has also rapidly increased. Now the second most common question that I get is why should we not invest into higher yielding stocks? Again, dividend growth stocks, for example, if we look at Microsoft again, typically have much lower starting dividend yields, with Microsoft having a yield of 0.74%. Again, if we look at a company like Home Depot, they have a starting dividend yield of just 2.35%. So if the end goal is to live off dividends, wouldn't it make a lot more sense to buy higher yielding dividend stocks? Let's go ahead and address this question. Now again, if our goal is to live off dividends, then our average monthly dividend payments needs to be above our average monthly cost of living. Now we need to understand inflation compounds over time just like any other investment. So for example, if our monthly cost of living is $4,000 a month, 30 years from now, if inflation on average is around 2%, our cost of living will be closer to $7,245. So we need to get our monthly dividend payments above this black line and stay above this black line. So now let's assume we're investing into a high yielding dividend stock every single month. If we jump over to my portfolio projection tab, I'll go ahead and zoom in, and you can see we're assuming I'm investing into a dividend stock that has a starting yield of around 6.5%, which is a pretty high starting dividend yield. Because of the high starting dividend yield, we'll typically see very little to no dividend growth, so I'm assuming 0% dividend growth. We're assuming $1,000 monthly contributions and a price growth rate of 6.5% with a starting portfolio size of $0. So again, the question is, can we get our dividend payments on average above this black line? If we jump over to our live off dividends analysis and look at this charted out, I'll go ahead and zoom out just a little bit. We can see at no point did this investing strategy get our monthly dividend payments above the black line, which is our cost of living, something that should be pretty frightening. But here's the beautiful thing. If we jump over to our portfolio projection tab again, and this time assume we're investing into a dividend growth stock. Let's say it has a starting yield of around 3.5%, a dividend growth rate of around 9%, and a price growth rate of around 8.5%. And again, assuming $1,000 monthly contributions, if we jump over to my live off dividends analysis, this time what you'll see is our red line did get above our black line, meaning right here our monthly dividend payment surpasses our monthly cost of living, meaning dividend growth investing allows us to live off dividends much faster than higher yielding dividend stocks. Now, with that being said, it is worth noting if you're someone closer to retirement or closer to being able to live off dividends, it probably does make more sense to allocate some of your capital to higher yielding stocks. So from a long-term portfolio projection standpoint, it becomes pretty clear why dividend growth investing is so powerful, but that doesn't explain the whole point behind investing in dividend growth versus high-yielding stock. Let's go ahead and look at one more example. The first thing we need to look at is Visa. Visa is a phenomenal dividend growth stock. We can see it has a starting yield of just 0.75%, but if we go over to dividends and look at the dividend safety of this company, we can see their cash flow payout ratio sitting at around 19%, meaning only around 19% of their free cash flow is being used to pay out dividends. Now if we jump over to the financial statement and click on the statement of cash flows, we'll go ahead and scroll down and look at the company's free cash flow per share growth over the past decade, and you can see it has been explosive. So the end result of this is massive dividend dividend growth, let's look at their dividend growth rates. We can see the 3, 5, and 10-year dividend growth rates all between around 15 to 18%. Again, massive dividend growth. And this was made possible because they weren't using all of their free cash flow to pay out dividends. They were using some of that cash flow to reinvest back into the business, in turn generating more free cash flow the following year, allowing them to pay out more in dividends. And now also the end result of this is if we jump over to the summary and look at the past 10 years, we can see market-beating returns with over 390% gains. Now again, the opposite of this would be AT&T. AT&T is a company who has had low levels of free cash flow growth, and they basically used all of their free cash flow to pay out dividends over the past year. And like I pointed out earlier, because of that, they eventually had to cut their dividend payments because they simply couldn't sustain those high levels of dividend payments. Now this also led to low levels of growth. In fact, they even saw negative growth over the past 10 years. So again, it becomes pretty clear that long-term dividend growth stocks way outperform higher yielding investments. Now the last question, and one of the most frequent questions I get, is why don't I just put all of my capital into high yielding savings accounts? And again, if we jump over to my dividend dashboard, we can see my current portfolio dividend yield on cost is around 3.71%. So with a portfolio size of around $158,000, we can see on average every month, I'm getting around $420. Now on the surface level, to a lot of people, that does not feel like enough income for the size of my portfolio, especially when you look at some of these high yield savings accounts. They're offering 4.6% annual percentage yield. We have some offering 4.35, 4.45, and some even over 5%. So while my portfolio is only yielding around 3.71%, we can see why this is a pretty popular question, and it's actually a question that I also had when I first started dividend growth investing. Now, unlike AT&T, high yield savings accounts aren't going to cut their interest payments. High yield savings accounts aren't going to cut their interest payments. Those interest payments are guaranteed. So basically with high yield savings accounts, you get a high starting dividend yield with pretty much no risk. So why would I want to buy a stock that has a lower starting dividend yield? Well, first of all, like I mentioned earlier, dividend growth stocks can see a lot of capital appreciation over time. For example, Home Depot up over 357% over the past decade. But even strictly from a dividend payout perspective, dividend growth stocks long-term way outperform high yield savings accounts. And this actually reminds me of one of my other favorite investing quotes. In investing, what's risky in the short term is often safe long term, and what's risky long term is often safe in the short term. So basically what I'm saying is obviously a high yield savings account could provide more immediate interest income than a dividend growth stock could in dividends over a 1-year time period. But what if you're someone looking to invest with at least a 10-year time period? So again, Home Depot starting dividend yield sitting at 2.35%, quite a bit lower than high yield savings account. But if we go over and look at their dividend history again, we can see those dividend payments over time increase dramatically. So if we look at the dividend yield on cost over the past decade for this company, we can see if we invested in this company 10 years ago, our yield on cost would be nearly 11%, way outperforming high yield savings accounts. So while investing into high yield savings accounts is safe in the short term, it's actually risky in the long term because you're missing out on massive opportunity costs. And the opposite of that is true. While dividend growth stock investing can feel a little bit risky in the short term, long term it is a no-brainer if you're someone looking to maximize dividend income. So when I was starting out, I made a ton of mistakes that beginner dividend investors typically make, like buying high-yielding dividend stocks and bad stocks that don't grow free cash flow over time. I didn't understand the power of dividend growth investing, but over the years, as I've switched to dividend growth investing, I've seen some phenomenal returns in my portfolio, and I can see my portfolio turning into a dividend snowball. For example, if we blow up my growth chart, we can see by far my best performers are dividend growth stocks. AVGO, I'm up over 140%. We can see Caterpillar, I'm up over 82.7%. JP Morgan, 66%. Microsoft, I'm up over 53%. And the beautiful thing about these investments is they're increasing their dividend payouts every single year. And if we jump over to my dividend dashboard and blow up my historical monthly dividend income chart, we can see my dividend snowball is really starting to take off. I'm clearly trending in the right direction. Now, dividend growth investing isn't some kind of new concept. It's the exact same concept Warren Buffett has used to be paid massive dividends throughout the years, and it's the same concept he's used to achieve a yield on cost with Coca-Cola of over 50%. Imagine getting paid over $500 every single year from a one-time $1,000 investment that could have been made possible with Coca-Cola. So now the key to building your dividend growth portfolio and letting dividend growth investments pay you big time is to find stocks that can grow their free cash flow and grow their dividend payments every single year. The goal of my channel is to find those investments and to be completely transparent with the moves I'm making in my personal portfolio. If you'd like even more updates on my portfolio and some of the opportunities in the dividend growth space, then you can sign up for my newsletter at the link in the description. You can also download any of the spreadsheets you see in my video on my Patreon page at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.